In this video, we look at the overnight call money market, or Fed funds as it is known in the United States. This market is essentially an overnight market, i.e. where financial institutions borrow and lend overnight, primarily to square off mismatches in their daily cash flows. As with any business entity, cash inflows and cash outflows in financial institutions are driven by a host of transactions that they undertake every day. For example, cash outflows arise from loans disbursed to individuals and corporates, purchase of government securities and corporate bonds, repayment of customer deposits, and so on. Cash inflows, on the other hand, arise from loan repayment by customers, sale of government securities and corporate bonds, fresh deposits received from customers, etc. At the end of each day, these transactions could result in a net cash surplus or a net cash shortfall for each institution. In addition to the cash flow dynamics that I just explained, banks in most countries also require to hold a specific percentage of their deposits as reserves with the monetary authority or the central bank of that country. This reserve requirement is essentially to protect banks from unforeseen liquidity requirements such as sudden excess withdrawal of funds by depositors, etc. Banks therefore assess their cash positions, i.e. surplus or shortage, as well as their reserve requirements on a daily basis, and accordingly borrow or lend in the overnight call money market. To understand this better, let's take an example of two banks, Bank A and Bank B, on any given day. Bank A has cash inflows of 6,000 and cash outflows of 4,000. Therefore, at the end of the day, the net cash inflow for this bank, i.e. it has a surplus of 2,000. Reserve requirements for this bank, let's say, is 400. So in the end, it is left with a cash surplus of 1,600. Bank B, on the other hand, has a cash inflow of 6,000, a cash outflow which is higher at 7,000, and therefore it has a net cash shortfall of 1,000. In addition, it has reserve requirements of 600. The two together means the net cash position for Bank B is 1,600 shortfall. Now look at this. Bank A has an excess of 1,600, so it can lend the 1,600. Bank B has a shortfall of 1,600, therefore it has to borrow 1,600. If these were the only two banks in the country, then the financial system in that country will be in equilibrium on that day, because the overnight cash surplus in one bank is exactly equal to the overnight cash shortfall in another bank, and therefore across the banking system they will be able to lend and borrow, so everyone's requirements is met. To summarize, if the cash flow surplus of some banks in any country's financial system is nearly equal to the cash flow shortfall in other banks in that same financial system, the overnight lending capacity, i.e. supply of funds, would be nearly equal to the need for borrowings, i.e. the demand for funds. In that case, the overnight call money rate, or the Fed fund rates as it is called in the United States, will be low and stable. Should the total surplus cash in any financial system, i.e. the supply, significantly exceed the shortfall, the overnight call money rates decrease or will fall, and it will increase if it is vice versa. In every country, the overnight call money market has only a limited number of participants. In most cases, only the regulated commercial banks and such other institutions specifically authorized by the monetary authority of that country. Hence, in almost all countries around the world, transactions in the overnight call money market are unsecured, i.e. no requirements to furnish collaterals of any form to borrow in this market. For the same reason, this market is also an over-the-counter market, not an exchange-traded market. Structurally too, the overnight call money market is highly liquid and a very flexible source of overnight funding for banks. In case of extreme swings in the demand and supply of overnight money due to unforeseen reasons, the monetary authority of the country intervenes to stabilize the demand-supply mismatch and thereby keep the overnight call money rates as stable as possible. The nature of such interventions, of course, and the tools used by the central banks could vary from country to country. Reported overnight call money rates as of the end of any business day is the weighted average of the trades carried out in the market during the day, or in some cases the rate of the last transaction executed in that market on that day.